Buckle up, everyone. You are strapped in and ready for the Insurance Hour with me, your host, Carl Susman, informing, educating, and entertaining Californians one policy at a time. This is Insurance Hour. Hello, and welcome again. This is Insurance Hour with me, your host, Carl Susman. Thank you so much for joining me today. Remember, if you have questions, you can call anytime at 559-656-0317 and email your questions to questions@insurancehour.com. Love getting the questions. Love even more if I can give them an answer. So feel free to do so, and I will do everything I can to get the right information to you or help you get to the resource that will help you get that correct information. Without further ado, let's jump right in. Some of the times that I'm talking, I say things and I'm using terminology that might be unfamiliar to people. And what I find when I'm talking to clients or when I'm talking to people on the radio is, in general, that it would be helpful if they had more of a basis of understanding and we had sort of a common foundation of what it is we're just talking about. So I wanted to spend a little bit of time now and go over some general insurance terms, which will probably lead me into some element of some, not just terminology, but how insurance works along those lines. So let's start out with that. First, we have the first level, I suppose you could say, is purchasing insurance, which is usually through an agent, a broker, or directly through the insurance company. And the first question might be, well, agent, broker, do you mean agent/broker, or is it agent or broker? Does it make a difference? And I'll answer you in general terms. Generally speaking, by definition, and again, this is not a legal opinion, I'm not an attorney, an insurance agent is an employee or specifically represents an insurance company. An independent insurance agent broker, or just a broker for the most part, has a bond posted and represents the consumer to many insurance companies. So there's a different relationship there, and you can draw your own conclusions or assumptions based on what might be better for you or not. There are pros and cons to both. And then there's the insurance company itself. Now, if we look at the insurance company, you might think of companies like Mercury or Safeco, Hartford, things like that, and that's fine. However, there are layers beyond that called reinsurers. And these are additional companies that work sort of in the background, and insurance carriers will utilize reinsurers to actually offload some of the risk and share some of the exposure with those insurance companies. You could look at them as insurance companies for the insurance companies. This is a good thing. This enables the insurance carrier that you might be purchasing your insurance from to not have all of the exposure on their shoulders. They're in essence sharing that exposure. They're sharing that risk with another insurance company. So if there's a major loss, instead of one pocketbook having to cough up the money, then you would have multiple insurance companies that could potentially be involved. One insurance company may have several reinsurance companies working behind the scenes, 3, 4, 5. It could be layered. There could be a type of insurance carrier that literally has no skin in the game for themselves. They simply have reinsurers that are backing all of their claims and all of their expenses and everything else that might be going on from there. So when we talk about purchasing insurance from an insurance company, you should be thinking about the carriers that you recognize, the carrier names that you'll recognize, like we talked about earlier. And when we're talking about brokers or agents, I'm talking loosely about those people that you'll call on the phone or you'll go online and you'll receive a quote from. Now, that brings up an interesting point. When you go online to get an insurance proposal, typically if you just go into a search engine and type in auto insurance quote, believe it or not, you may not see the first choices being from an insurance company or an insurance broker. If you look carefully, what you might find is you're going to have what's called an insurance lead generator. What that is, this is a separate company. It does not have any affiliation with an insurance carrier. And what they're doing is they're spending lots and lots of money to raise themselves up to the top of the search engine ranking. And they're also showing up as sponsored search, right? Again, your mileage may vary depending on the particular search engine that you're using. It might look like an insurance company. It might have a flashy name like Best Auto Quotes or something along those lines, but this is not an actual insurance company. It's just a company gathering your information as a lead. Now, you'll go to this online and you'll start putting in information. And it might look as if you're actually going to be getting an auto insurance quote in this example. You'll put in your name, your email, your phone, the vehicle ID number. You might put in limits of liability you're looking for, different types of coverage. However, when you finish, that's when the surprise comes. When all of a sudden you realize that, oh, wait, I'm not getting a quote. I'm being told, we'll get back to you with a quote right away. Or someone will be reaching out to you shortly. Now, what that means is behind the scenes, there are insurance companies or insurance brokers or agents that pay that company to send them that lead. What does this translate into? Well, it translates into all of a sudden you're going to start getting a ton of emails and a bunch of phone calls from agents and brokers that say, hey, I see you want to get an auto quote, and they try and quote you the insurance policy. As you can probably tell by my tone, it's not the best experience because now you're also in the big machine. You now are in a position where you're not just going to start getting calls and emails from agents and brokers and insurance carriers to offer you that quote. Now your information is going to probably be resold to another aggregator, another online platform that will buy what are called aged leads. What's an aged lead? Well, if you're asking for the quote on the 1st of January and it immediately gets sent out to agents, they're going to pay a premium for that because you just asked for it right now. Now, what happens in a week? Are you still looking for that auto quote? Maybe. Perhaps you've purchased it. Perhaps you were just looking to see what it would cost to insure a car you were looking to buy that you decided not to buy. Either way, a week goes by, that lead is worth a little bit less. So they will turn around and sell those leads again to other brokers or agents or insurance companies, and they will say, this lead is 7 days old, and here's what it costs. Well, what about 2 weeks later, 3 weeks later, a month later, 6 months later, a year later? Yeah, it can get that bad. You will literally be in a position sometimes of getting emails that you think are just, how in the world do they have my information? Well, it might be from a form you filled out 6 months ago to get a proposal that now is all of a sudden coming from some carrier or some agent or some broker that you've never heard of. And that's because your information was sold, resold, and resold and resold. And now you're getting contacted by a new group of people. I'll tell you a little bit about my personal experience with this on the broker side because I found it fascinating. We don't utilize any of these tools. However, this is what it looked like back in the heyday when this was brand new. You would get an email that said, hey, here's the information on a client. They want an auto quote. And you'd call them. And if you were the first person to call, they'd say, wow, hi, that's great. I just put that information in the computer. How awesome it is. You're calling me right now. You give them the quote and they say, okay, well, I'm still shopping around. I'm going to wait and see who else calls me and what other quotes might come in. Okay. Then if you happen to be one of the agents that calls second, third, fourth, fifth, now the client's getting a little annoyed. They're saying, oh my God, okay, you're the fifth agent that's called. I've already got quotes. I'll decide, please stop calling me. Well, that one agent will say, okay, and stop calling you. But that process will continue. Like I said, for days, for weeks, for months, because that information is sold and resold and resold. So if you're the first agent that calls, normally you're in a position of, wow, that was fast, but I still want to get other numbers. And if you're the last agent that calls or one that calls later on in the process, then you're in the position of being told, oh my gosh, stop calling me. I keep getting these calls. I don't want any more calls. Enough's enough. And you're not going to make the sale. So you can probably tell that from the broker standpoint, it's not usually a good experience because you're either too soon or you're too late. And somewhere in the middle is the sweet spot. In the beginning, when this was first starting to happen, it was a lot easier and it made more sense because there weren't a million companies doing this. There weren't a million brokers that were paying for it. There was no such thing as old leads. It just came in, you want it, you pay for the lead and you move on. But now it's changed. There are also companies that will, if you call in for a quote, they will literally say, they'll gather some basic information and they will turn around and warm transfer you to an agent or broker. So you're sitting there, as we say, aggressively waiting to answer the phone, and you're going to get a call from this company that you're paying to warm transfer that lead to you. Same problem happens from there. You might give the proposal. It might be good. It might be bad. People are shopping. But the poor client, the consumer, is going to continue to get calls later and continue to get emails later. Now, as awful as this sounds, and it's pretty awful, I've tested it myself. This was one of the reasons we stopped doing it many, many years ago. The consumer experience is horrific, as bad as it sounds. And it's not anything illegal, because when you're initially giving that information, if you read it and you're ticking all the little boxes, the disclaimers that you scroll through, if you read them, you're in essence saying, here you go. You got the info. Have a good time. In essence, you are relinquishing your rights to that information going forward. And my guess is that, again, not an attorney, if you read it, it probably has a particular time frame, but it's a long one. And then, of course, you do have some bad actors out there that will buy and sell those even after those dates. So what's the moral? And I went off a little more on a tangent about these online systems than I meant to. And we'll come back, I promise, to where we were, which is insurance terminology. What I want you to be aware of something. How do you avoid this? And the way you avoid this is you need to be careful when you're going online and requesting insurance proposals of what information you're giving and who it's actually going to. Now, this experience would not happen, for example, if you went to a specific broker, because typically that broker has no interest whatsoever in passing your information on to anybody else. They want to write your insurance, period. They'll either write it or they won't. There's nothing else for them to do with it after that. They're certainly not going to sell it to a competitor. Hey, I didn't do it. Maybe you'll have better luck. Doesn't work that way. So if you're giving the information directly to an agency, you're less likely to have that experience. If you're giving your information directly to an insurance company online, you're also less likely to have that experience because same reason. They want to either quote the insurance or move on to the next one. They don't want to pass your information on to a competitor. Unfortunately, or fortunately, depending on your perspective, I presume, you are still going to have the potential to get into that cycle, if you will, of having people call and email later, but at least it's going to be the same broker or the same insurance company. They might keep your information and say, well, you reached out a month ago. Did you ever get a quote? Because we're here, if you want to get the quote from us. Automation makes this just too darn simple to avoid. There's no sugarcoating it. So pay attention to the companies online that you're putting this information into and understand that you may be very much at risk if you're picking one of these aggregators, knowingly or not, that your information is going to explode. It's like fireworks. It starts out inside the canister, they shoot it up and it's still just one piece. It gets to the sky and then boom, it explodes into all these lights and all these different places. Your information, when it goes to one of these aggregators to begin with, is like that. And the lights are bright and shiny and they'll slowly fizzle out, but there are a lot of them. And you should be prepared and understand how that happened and why that happened. I also recommend if you're really aggressively looking to get quotes all over the place, which I don't recommend, but if you are, might be a good idea not to use your primary email address. You can use some of these throwaway email addresses that you can get online. I believe there are certain options with Google, with Gmail and iCloud and Apple, where you can get temporary email addresses that you can use for a day to a week, however long, and then basically delete them or they go away. And that's a good idea. If you're going to be putting in information and you don't want to be bombarded forever, that sometimes is a good way for you to be able to avoid that perpetual contact and recontact for something. All right. Without getting into a cyber discussion, we'll move on. So consumers go to insurance companies or brokers to obtain insurance policies. Now, when they want to do this, they have to provide information. So you might be asking, so at some point, I have to give some of this information to somebody, right? And the answer is yes, you do. And you want to give as little as possible initially until you're comfortable that that's going to be the person or organization you're going to work with. Now, that's hard to do because it's a chicken and the egg. You can't quote somebody's car without information on their car. You can't quote someone's life insurance without knowing their age, where they live, what they do for a living, and some health questions, right? So it's definitely a fine line that you have to try and walk between what information you provide and what information is required to get that bare bone first quote, that low level, what's the rough estimate going to be? So I don't want to talk anymore about how to get quotes, but I want to go back to terminology. So let's take a quick break. And when we come back, we're going to talk more about insurance terminology and things that you should know.
California's insurance market can be challenging, but Susman Insurance Agency knows the way. Trusted for 2 generations in home, auto, and personal insurance. Call 877-411-5200 or visit susmaninsurance.com. Navigate with confidence.
Ladies and gentlemen, boys and girls, in just a few moments, the Window to the Magic podcast show will begin.
My name is Patrick.
My name is Calvin.
I'm Mouseketeer Gray.
My name is Paul, and I will be your guide through the wonderful world of Disney sound experiences.
This show is a weekly trip into the world of the Disney theme parks and resorts.
And this is the place where you get to use your ears to surround yourself with the magic.
For your safety, please remain seated while listening to the WindowToTheMagic.com podcast.
Maybe there's a name for this, something like Disnotic obsession. Please visit WindowToTheMagic.com for more information, or you can find us on Apple Podcasts and in the iHeartMedia app.
Hello, and welcome back to Insurance Hour with me, your host, Carl Susman. I appreciate you being here. Remember, if you have questions, please call me at 559-656-0317. Email any questions to questions@insurancehour.com. Or if you need help right away, you can dial pound 250 on your cell phone, use the keyword insurance, and you'll get connected to someone that can help you right away. Before the break, we were talking a lot about how to obtain insurance quotes and some of the pitfalls that can occur in the event that you are going online and trying to get quotes that way. I don't mean to scare you. Let's face it, we're all going to be going online to do some research before we're getting insurance quotes and things of that nature. But be cautious. Now let's move on. So we have insurance companies, we have insurance brokers, and we have those reinsurance companies. Now, what happens when you apply for an insurance policy? Well, there's a process that has to happen called underwriting. And the people that do this are called underwriters. I know, very, very unique. I'll give you a little trivia and a little history lesson as well. Where did this come from? Well, many years ago, you may have heard of Lloyd's of London. This was the first insurance syndicate. There were ships that were leaving the UK and coming to the New World. And well, boats weren't as great as they are today. And what was happening is a lot of those boats were not making it. And as you can imagine, that was costing the investors that were sponsoring the cargo and sponsoring the ship to go a lot of money. So they decided, maybe we can share in a little bit of this. So they would put boards up, literally on the wall or standing boards, and they would write out, this is the name of my ship. This is the cargo that's going to be on it. This is where it's going. This is the amount of money I'm going to need in order to help sponsor this to be, to actually get this ship out. And here's how much you can possibly make if you help me, all the basic information. And then people, investors would walk around. This is the original Lloyd's of London. They would read these boards. And if they saw something they liked, they would write their name on it. They would underwrite. They would write under that explanation of that particular risk, which meant that they were going to commit however much money they were going to commit to that particular venture. So underwriting gets its name from the concept of literally the days when somebody would write their name under a proposal, and that proposal would be for something that could be profitable or could take a loss, and they were willing to take that risk with them. So underwriting, pretty cool, right? So underwriters have the job of looking at a risk and deciding if it's eligible for any programs they have, what they're going to charge, what discounts might be available, all sorts of information about that particular risk. Now, it's different for different types of insurance. Let's just talk about auto insurance because that one seems to be the most common and people are the most familiar with. When you're applying for auto insurance, and it depends on what state you're in, you're going to have your information go to an underwriter. Now, this could be automation, right? A lot of underwriting can be done in an automated fashion that prevents discrimination and things of that nature. However, in general, your information is going to go to an underwriter. So they're going to say, okay, you want to get liability insurance and you want to get coverage for your vehicle. So here's what we need. We need to know what the vehicle is, right? They're going to want the year, make, model, and the vehicle ID number, the VIN number. You know, that long number, it's in the dashboard and in the inside of your card or jam, right? That long string of digits, which gives it which provides very specific information about the characteristics of the vehicle, the different types of options that it might have. That's going to give them information about the car, right? They need to know all they can about the car in order to make an informed decision about what they're going to charge. Then, since they're also going to be providing you with liability insurance, right? They're insuring you as a driver. They're also going to ask questions about you. They're going to ask your name, your age, how many years have you been driving? They're going to want to run reports such as your driving record. They're going to want to see, have you had tickets? Have you had accidents? Have you had your license suspended? Are there any issues going on that could potentially impact your ability to drive? They might look at your driver's license to be sure that you haven't had some previous significant infraction and had the license suspended, because that would make them potentially less likely to want to take that risk, right? Because insuring you means they're basically saying, I'm betting on you. I'll take that risk. So they want to gather as much information as they can about you as the driver to try and make that decision. Do I want to take that risk, right? Because that is, at the end of the day, what an insurance company does. They're in the business of taking risks. And in order to do that, they need to know what that risk is. Depending on what state you're in, states have different guidelines from their different departments of insurance that will allow an insurance carrier to gather certain types of information. For example, some states will allow an insurance carrier to also run what's called a credit score. It's similar to a credit check, but they're not actually pulling your credit. But they are checking some factors on your credit score, on your credit report. The thought behind it, and it's been proven for probably decades and decades and decades across the vast majority of the country, people that tend to have a cleaner credit record tend to have fewer claims. Why is that? Well, I can speculate that some of the reasons might be things such as, well, if you're paying attention to your bills, you might pay attention more when you're driving. If you're having financial difficulties, you might not be maintaining your car. It might have a tire blowout. There are things that you and I could sit and speculate on. Why does this insurance score matter so much? But just take it at face value. It tells a lot of information. Some states don't allow it to be utilized as a form of underwriting at all. Primarily, it is utilized in the majority of states. And that's why there are direct correlations between different parts of your insurance score and your propensity to have a ticket or an accident or a claim or other such things like that. So they're going to gather, the underwriters, information about you to decide if they're going to take that risk or not. Right? They're going to decide, am I going to sign my name as an insurance company on this board under this person's auto insurance policy? They're going to look at the information on the vehicle. They're going to look for information on you. They're going to look at the limits that you're looking to carry. Are you looking for a high deductible? Are you looking for a low deductible? Not only will that impact the price, but that gives them an idea of how potentially frequent you might utilize this policy. If you're looking for a $50 deductible, the underwriter is going to look at that and say, okay, this person plans to put in a claim for every little scratch that might happen on the car. Versus if they're going with a $2,500 deductible, they're going to say, okay, they're probably only going to put in a claim if something significant happens to the vehicle. So not only will that affect the price of the policy, but it may also impact their decision as to whether they're going to accept your risk or not, because that's something that they're allowed to potentially look at and make a judgment on. So underwriters will decide what this risk profile looks like by looking at all of the information that they're provided, all of the information they're allowed to look at, and they're going to take that information within the guidelines and the rules and the regulations that they're provided, and they're going to either accept the risk or reject the risk. If they reject the risk, pretty simple, no option, no quote comes back. If they accept the risk, then they're going to come back with a quote or a proposal. They're going to say, okay, in order to give you coverage for what you're asking for, we've done our homework, we've done our underwriting, we've looked through everything we're allowed to look through, and we've decided that the cost is going to be X number of dollars. And after those X number of dollars are paid in premium, then you're going to be able to have coverage based on what it is that you are asking to get coverage for. So the underwriter has to look at all of the information, and after they look at all of the information, then they're going to turn around and either accept you or reject you. And if they accept you, they're going to give you a price, at which point you turn around and either accept that price and accept the policy as it's offered to you, or, of course, you're the consumer. The customer is always right. You can decide, this is not for me. You can decline to accept the policy and move on your merry way and go and obtain coverage somewhere else. So that's the basic cycle of what happens when you apply for a policy with an agent, a broker, or a company. It goes to underwriting and then comes all the way back to you as an insurance quote. So now that you have a general idea of how that flow works from consumer to either agent or broker, or to insurance company to underwriter, and then back to the consumer if they decide to move forward, dig a little bit deeper in what happens. We talked about underwriting. We talked about how underwriters work, what they're looking for, what they're doing. Something that's very important to keep in mind. State by state by state, the Department of Insurance makes decisions on what is underwriting allowed to look at and what they're not allowed to look at. And I can't emphasize this enough, because that has so much to do with the rate that you're going to pay for your insurance. Now, you might look at certain states that have higher insurance premiums. You might look at states that have lower insurance premiums, and you might want to try and find a correlation between, well, the carriers that are giving more information to the insurance companies to underwrite based on how does that impact premiums and vice versa. And that would be a fair thing to do if those things were able to be causality versus causation, right? So the question becomes, is it one thing that's creating another or the other way around, right? Most of the time, when you're given more information as an insurance company, you're able to make more granular decisions based on price, product, and everything else in between. When you're given less information, then you're able to generate less accurate premiums based on the exact risk that you have, right? For example, if we're talking about car insurance, if you are in a state, and let's just pretend this state only lets you look at one thing, and that's the age of the driver, then you would expect that the rate that that driver pays is going to be much higher than a state that says perhaps you can look at the age of the driver and their driving record. Because the driving record, obviously, we can understand would impact their propensity to have a loss, right? So what does an insurance company do if they're in one of those two states? Well, if they're in the state that gives them more information, they're able to be more specific and charge premiums as specifically as possible toward the exact risk of that particular person. And if you're in the state where they're given less information, they have no choice. And I'm not playing the insurance violin by any means, but in order to make it work, they have to charge a higher premium because they have to be able to cover their bases. They have to be able to have enough premium coming in for the people with the bad driving records. And of course, that premium would be more than they would need to charge for the good ones. But since they're not allowed to gather that information from the consumers, they have no choice but to charge that higher premium. So as a general rule, you're going to find that states that give the ability to underwrite with more information provided are able to generate lower insurance premiums. And hopefully now that makes a little bit of sense as to why. Now, consumer groups, privacy advocates, they don't like this. I get it. If you really want to go through and get a profile on someone, there are unbelievable numbers of data points that you could go based on. Everything from your credit rating to where you live, to how long you've lived there, to your buying habits, to do you have a firearm or not, to do you drive a sports car or not, to down to what octane gas you might use. There are so many data points that are available. It's kind of scary. I understand the fear of releasing that level of information. No, thank you. And having said that, at the same time, I'm able to understand that, well, how much of that am I willing to give up if it's going to save me money on my insurance premium, right? So it's a strange balancing act that we're stuck in, because on the one hand, we want the lowest rate we can get. We want carriers to compete for our business, and they can do that better when they have more data. Because let's say one carrier thinks that, well, this particular type of sports car is going to cost them X dollars to repair, and another one says, no, we think we can get it repaired for Y dollars. So they would be able to charge different premiums. The more companies writing insurance, the more competition, and that lowers the rate for everybody. That's obvious, right? I mean, I don't have to explain why competition lowers premium. We get that. Problem becomes, how much information are we comfortable providing to a third party like an insurance company to get the best rate? Are you willing to give them, let's just say, your date of birth? Probably. Are you willing to give them your address? Probably. Are you willing to tell them if you're a smoker or non-smoker? Yeah, probably, but you're starting to get a little bit uncomfortable. Are you willing to tell them whether you use medical marijuana or not? And we're going to go on the auspice that it's legal in the state you're in. That might give you pause, because you're going to be thinking, well, it might be legal in my state, but it's not at the federal level. How are they going to look at that? You might start getting a little uncomfortable. What if they went one step further and they started asking some health questions? They said, do you have migraines? Do you suffer from migraines? Do you have asthma? Why would they ask these questions? Well, again, we're just using some imagination here. Someone that gets migraines, me, by the way, might be more likely when they're driving, if they have a headache, to not be as safe a driver as someone who might not have a headache. Let's face it. When you get a bad migraine, you get sensitivity to light, and you can be pretty darn miserable. Do you want your premium adjusted based on that health factor? What about the asthma? Well, why does that matter? Well, what if someone is driving and they have an asthma attack? Are they not more likely to have an accident than not? You see, it's a slippery slope. And we get to a place where we have to decide, how much information are we willing to give, and how much information are we willing to let the insurance companies utilize to price risks? This is the other interesting part of that. You and I don't get to make those decisions directly. I can't go to an insurance carrier and say, okay, I'm willing to give you this information and nothing else. It doesn't work that way. The Department of Insurance in the state that I reside makes those decisions for me. That's why I said I can't decide directly. I can decide indirectly because I have the power of the vote, right? Some states have an elected insurance commissioner. I can vote based on that. Some have an appointed insurance commissioner by the governor. Well, I can vote for the governor. So I have a very indirect vote and decision when it comes to what information the carrier in my state is allowed to ask. That makes me uncomfortable, because now, remember we were going through all these examples? I don't really get that choice. I don't really get that ability to make the decision as to whether we're going to give you a rate based on a little bit of information you provide or a whole lot of information. I don't get to make that choice. And I don't know about you, I like to be able to decide what information of mine I give up and why I'm giving it up and what it's worth to me. That's just not the way the system works. It's an interesting place. I forgot exactly which state it is. I want to say Kansas or Missouri. One of them they use credit scoring or insurance scoring, as it's called. And they had, I believe there were over 20 price points for the same driver based solely on what that insurance score came back. Now, what does that exactly mean? That means that whatever information the Department of Insurance in those states allows them to look at, if you look at all of that information and you have the same person and the only thing that's different is their insurance score, you would have 20 different prices potentially. Wow. Talk about granular. And talk about, really? Is that justifiable? Insurance carriers, if one thing they are good at working with large numbers. They have been able to find ways to utilize those numbers to be able to better predict loss. Otherwise, they wouldn't do it. There's no other reason to. The fact that there are so many price points in that particular state speaks to the fact that information matters. The more information, the better. In this case, they're able to break just that one aspect down and give 20 different price points. And they varied significantly. We're not talking about the difference between $5 or $10 between what the lowest premium would have been and the highest. We're talking significantly higher premiums. So where do you fall on that spectrum? Where do you fall on that continuum between, I don't want you to have any information on me, to I'm willing to give you anything you want. You want to count the moles on my back? Fine. If you think that's going to lower my premium, take a look. We all fall somewhere on that, and I'd love to know what your feeling is. So shoot me an email at questions@insurancehour.com or leave a comment below. I'd love to see what your opinion is and why, because this is something that as time goes by and as we're dealing with issues of insurance and we're dealing with the changing marketplace, this is going to be a huge issue. This is one of the issues that's impacting premiums across the world right now, because what's happening is due to many factors. We'll just summarize a few and say things like change in weather patterns, change in claim frequency and severity, cost of goods and services, inflation, just to name a few. We are seeing insurance premiums globally increasing, and not a little bit, a lot more than we're used to seeing them. So the pushback is going to be, okay, what can we do to try and lower those premiums? And the instant, immediate answer, and hopefully now it makes sense to you, is, oh, give us more information, give us more data points, and then we can try and find ways to better extrapolate what the risk looks like and what the premium should be. But where and how much and who decides? These are the questions that we have to deal with. And I think the best way for us to deal with these questions are to literally discuss it. People need to understand that. People need to understand why. I'll give you another example. There's something called telematics. And generally speaking, that has to do with driver behavior. What does that mean? That means, do you slam on your brakes a lot? Do you accelerate? Do you stomp on the gas after every red light turns green? Are you making turns really hard and fast? Things like that. Do you drive a ton of miles a day, or is work and home pretty close to each other? You know, these are issues of what are called telematics. And those issues are accessible in some states and not in other states. So here's another example. Your vehicle, it has a lot of that data. It can keep track of it. It knows it. I can tell you specifically that Tesla has a system where, depending on which vehicle you have, what year, and what types of features and options you have, you're actually able to get a score from the car that tells you how safe it thinks you're driving. And it keeps track of that based on things that I just said, such as how often are you slamming on the brakes? How often are you accelerating really hard? How often are you making really hard turns? Now, you and I can sit there and say, that kind of makes sense. I could see that being a realistic thing to potentially look at to determine what you're going to charge me for my insurance premium. But guess what? It's highly controversial. People don't like it. That's past that threshold of comfort, even though our logical brain says, yeah, I can see how that would impact my insurance premium. The guy slamming on his brakes all the time, pretty soon he's going to not do it soon enough. He's going to rear end somebody, right? The guy that's stomping on the gas every time he starts from a dead stop, maybe he's racing, he's driving. I mean, he's obviously in a hurry. When you're rushing, You know what happens when you're driving unsafely is when you're rushing, you're usually driving unsafely, or certainly not as safe as you would be when you're not rushing. But there's something about the idea of having that level of information accessible and available and being utilized. Now, we're already at the first two. It's already being recorded. It's already accessible to, for example, your car manufacturer. It's not accessible to all insurance companies in all states. So what do you think about telematics? Is that something that you're comfortable with? If it would lower your premium? Well, what about the other way around? What if it would raise your premium because all of a sudden they're able to say, whoa, look at the way this person's driving, and they want to raise the rate based on that? Is that fair? You might not think it's fair because you drive that way. Your next door neighbor who drives safely, or let's just say less aggressively or more carefully, would think it's very fair. Who decides? What's the line once again? How about this as a potential problem? And I've heard this argument made many times when it comes to telematics. What happens when someone else drives my car? We're a one-car, two-driver household. How could the insurance company possibly know if it's me driving like a maniac or my significant other? Well, that's a real problem. Not a complicated solution, but it's a problem. In the early days of telematics, when they were just starting to test if there was actually any statistical significance to this, they were using apps on your phone. And the apps were smart enough to know if you are opening a car and sitting in on the left side of the car or the right side of the car. They could also tell based on which way you got out of the car. So it was able to use that motion because you're holding your phone or it's somehow on your person to be able to determine, oh, this was a driver or this was a passenger. I don't know. I thought that was pretty cool. But again, back to the main idea, are you comfortable having that level of information out there for the insurance industry or for any other industry for that matter to be able to rate you or judge you, which is what rate you means to a lot of people, and come up with a premium based on? It's an open-ended question. There is no easy answer. But that's telematics, and that's the tail end of the underwriting process that I wanted to touch on. When we come back, I want to talk about some other terminology and some other parts of the insurance process that we should all be familiar with, and then we'll see if we have any other questions at the end.
I'm sure many small business owners out there have been hearing a lot about fractional CFOs, but aren't quite sure what they are or how they can help. Let Semaphore guide you and help fulfill your fractional CFO needs at SemaphorehQ.com. We're likely the solution to your business struggles and you didn't even realize it. A fractional CFO is a part-time, on-demand financial expert who can help you with scaling and tracking your financials and making smart financial decisions. A fractional CFO is more than just a number cruncher. They are a strategic partner to the founder and a trusted advisor to the growing leadership team. If you are interested in learning more about how a fractional CFO can help you scale your business, call or text us today at 720-766-8869 or check us out at SemaphorehQ.com.
Hello, and welcome back to Insurance Hour with me, your host, Carl Susman. Remember, you can reach me anytime at 559-656-0317 or email questions@insurancehour.com. If you need help right away, you can dial pound 250 from your cell phone, use the keyword insurance, and get connected to someone that can help you right away. Before the break, we were talking about telematics, and we were talking about underwriting. We were talking about how an insurance company decides whether you're going to be an acceptable risk for them to take or not. And if you are, how do they determine the price they're going to charge you? So let's assume that we've gotten to a point where you're acceptable. You now have that policy. You've accepted that insurance policy and you are an insured person under it. Let's say you have a claim. Let's talk a little bit about claims. Now, I always get a kick out of it when I stop and think about it. What is it called again? Claims. So basically, it already has this feeling of, do you really? If I claim this is what happened, doesn't that almost sound like there's something going on that you're missing? You know, if all of a sudden I come home at 3:00 in the morning and I've got lipstick all over my face and my tie's undone and I smell like alcohol and I come in and my significant other looks at me and says, "What happened?" And I claim, "I don't know, I was just at work late tonight," right? That's not going to be real believable. So for some reason, we have gone with this terminology. It's called a claim. And that is what you have to put in the event of an accident. If you're driving a car, or damage to your home, if it's a property insurance loss, something to that effect. So I understand, and it's always been a little bit of a frustration for me, that everyone has this immediate, because they have to file a claim. In essence, they feel as if they have to prove themselves. They have to justify everything that happens, because after all, it's just what they're claiming. We'll see what really happened. It's just what you're claiming. And it doesn't have to be that way. And let me give you some ideas of why it doesn't have to be that way and why you shouldn't feel that way, even though you do, and I can understand it. Claims get assigned to a claims adjuster. Now, a claims adjuster has the job, and it is a thankless job, of dealing with people after they have had a loss, right? You're filing a claim when you've had a loss, and a loss means something bad has happened. So talk about a job where every single day you're in a position where you have to talk to people that are already annoyed and upset because something bad has happened, right? Loss is bad. So they're dealing with people from the get-go that are not at their best. Is that fair to say? So the claims adjuster has the job of looking at what you're saying happened, looking at the insurance policy to see what coverage would be triggered, and then determining what the appropriate amount is to pay you based on those two factors. That's actually a lot if you think about it, because first they have to take the information you're giving them, they have to look at the insurance policy, they have to find in the insurance policy specifically what it is that you're saying you have coverage for and are looking to get money for. They have to be sure that it is covered. And then they have to turn around and figure out how to best get the proper amount of funds to you. That's a lot. It's a lot of work to do. It's a complicated task in and of itself. And remember, they're not just doing this for you. They're doing it for a ton of other people at the same time, in parallel. Talk about multitasking. They are adjusting claims. That's what it's called when a claims adjuster is working with a client. They are adjusting the claim. They're going through that process with, it could be dozens, 20, 30, 40, 50, 100 or more clients at the same time. And everyone is at a different point in their claims process. Some people may have just filed the claim. Some people might be 6 months into it and they're having work done and they're getting paid and things are happening, and everything in between. So the claims adjuster has to deal with all of these different aspects. Now, what happens if on top of all of that, you throw a monkey wrench in and you're that person that shows up with the lipstick on your face and the tie undone and the hair done and smelling like alcohol, and you're claiming, air quotes, something, and the claims adjuster now has to turn into the position of being not only doing all of those other things, listening to your information, seeing how it applies to the policy, figuring out how to compensate you. They also have to try and figure out if you're telling the truth. Yuck. The best thing you can do when you're working with a claims adjuster is be as open and transparent and human as possible, because you're dealing with another human being. And you're dealing with someone that really is just trying to do their job. And again, of course, I'm speaking generally. Some claims adjusters are awful and they shouldn't be doing what they're doing. But I'm speaking in generalities. The best thing you can do is be open, be honest, be transparent. Because the last thing your claims adjuster wants is to have to put on that other hat of truth seeker to try and decide what you're saying is true and what you're saying is false. And I get it. I understand that when you put in a claim, you want to get your money. You want to get what you feel you're entitled to. That's the way insurance works. It's a promise, right? You pay premium. The insurance carrier promises to do certain things like pay you, depending on certain types of damage that might happen or certain type of losses that might occur. So it makes sense that you want to put your best foot forward and present the right, air quote, right information to be sure that you get that. Unfortunately, what happens sometimes in trying to put that correct information forward, it can be embellished. not even intentionally all the time, or it can seem insincere, or it could just plain old be an exaggeration. Sometimes people will try and exaggerate, not because they're trying to commit insurance fraud, even though, guess what? It is. Because they just want to make it easier. I've talked to people, and they literally are not trying to commit insurance fraud. They simply are trying to be sure, using those words, that they get their claim paid because this really happened. And they end up shooting themselves in the foot because they provide inaccurate information or exaggerated information. And then it puts the claims adjuster in the position of having to put on that truth figure, that truth hat, and have to pass it on to another claims adjuster or someone in the legal department or who knows what. So the best thing to do, because insurance policies are contracts of utmost good faith. And that means that everyone needs to act in the best faith, good faith possible. You need to be as honest as you can. The adjuster needs to be as open and honest as they can be. And if everybody did that, if literally everybody worked from that playbook, we would have a much better claims experience. Unfortunately, it doesn't happen that way all the time. I don't know what the statistics are, but I suppose if we talk to some claims adjusters, if there's any of them out there, feel free to chime in, shoot me an email, or leave a comment. I think more often than not, you're going to hear people exaggerate. They want to, quote unquote, fill their deductible, which is just a fancy way of saying exaggerate and lie about what happened so you get more money so that your deductible is met and then you get more money. That's insurance fraud. I understand the motivation. I understand that people don't necessarily look at that as being the end-all, be-all, worst thing in the world, but it is insurance fraud. And it changes the entire tapestry that the insurance claims adjuster is working with, because now they can't just take everything you're saying at face value. They have to look a little harder. They have to be sure. Because again, at the end of the day, you're entitled to what the policy says, regardless of whether you're telling the truth or lying. Although if you're lying, the policy can be voided. There could be something called rescission, which is where the insurance carrier says, okay, we're not paying for this. Here's all of your premium back, and they walk away. Nobody likes to do that. That is bad for everybody. And I hate to leave on such a negative note. So take this positive statement with you. When you're dealing with claims or a claims adjuster or claims anything, remember, honesty is the best policy. Transparency is the best policy. Consistency is the best policy. Remember, you're dealing with human beings. You're dealing with people. They may have an off day. You may have an off day. But remember, the plan is follow the policy, listen to the insured, and make the premium and make the claim payout accordingly. And as long as we all follow that path and we're all on the same page, that's what you should be expecting. I do want to thank all of you for taking the time to listen today. I know insurance is not necessarily the most sexy concept. It's not the most exciting thing in the world. It is important that you understand what it is you're getting, what you should be looking for, red flags, you name it. You just need to know more than you used to. Things are more complicated than they used to be. If you have any questions, please reach out to me directly. You can email your questions to questions@insurancehour.com or call and leave a voicemail at 559-656-0317. Educating and entertaining Californians, one insurance policy at a time. This is Insurance Hour. This show is dedicated to Shamrock Papa.